So we got the markets down, obviously. Dow down for a fourth day in a row. Oil is weak. Let's get to Bob Pisani, see what's moving inside. Hey, Bob.
Good morning, Carl. Happy Thursday, everybody. Week open, 4-1 declining to advancing stocks. And it really started yesterday around 2 o'clock Eastern when the Fed minutes came out. Very odd because Fed minutes normally not a market-moving event, but it was yesterday. I think the concern here is, and we've lost 30, 35 points since that Fed minutes came out yesterday. I think the tone around the reopening story for the Fed is a lot more pessimistic than the market's own narrative, and I think that's part of the problem. Jobless claims may have added to that a little bit today. But if you look at the sectors, broad swath of sectors are fairly weak. Even the semiconductors, NVIDIA had a great report, so maybe some concerns about data centers, but they're down about 1%. Most of the other ones, except Intel, are down today. Banks and energy, industrials, a fairly wide swath to the downside. Only real estate peeking its head out into positive territory. The rallies this month we've seen in the travel and leisure stuff that we saw earlier starting to fade the last few days. So we've seen some weakness in the major names here: Carnival, United, Hyatt, Avis, of course. Keeping an eye on all those names starting to fade. Speaking of travel and leisure, I know Jim mentioned the Airbnb thing, but I think this is very interesting that the last valuation, this is a confidential filing, so we don't have any numbers of what they're floating here, but $18 billion is the April round of funding, and the prior to that was $31 billion. People said, my heavens, this is 40% lower. But that's not a big surprise here. 40%, 50%. That's what all these travel and leisure stocks have been declining from their recent highs. So if you look at just all the names, Royal Caribbean, any one of these hosts, Southwest Air, all the airlines, all the hotels, they're all 40, 50, 60% off of their recent highs, most of which were hit in February and March of this year, or January and February of this year. So not a lot of surprise here about the lower valuation. You'll notice all that talk about what was going on with a direct listing, all that went away. I think they do need the money at this point. I think it's interesting. I know Jim mentioned the Intel's program, but the $10 billion buyback program, it's interesting because we just haven't seen many of these buyback programs at all here. Now, obviously, Bob Swan says that the company is trading below its intrinsic valuation. That's a fairly obvious statement for the company to make. They've been notably underperforming since their July earnings and guidance report at the end of July, notably underperforming the whole semiconductor group overall. But I think the important thing is just take a look at what's been going on here with the share count reductions. There's been half the amount of share buybacks this year than announced last year, about $90 billion in the second quarter. That's half what it was last year. And what we're seeing now is the share counts are no longer reducing. The buybacks are not reducing the share counts in the S&P anymore. Remember, share buybacks reduce the share counts if they're aggressive enough, and that makes the earnings look better. This has been a big feature for the S&P for years now. For the last 4 years, 2016, 17, 18, 19, the share counts have been going down on the S&P, and that's made the earnings look better. This year, it's not happening, and it's not happening because the buybacks are not as big as they used to be, and companies are actually issuing more shares to have the liquidity. So all of this, I'm bringing this up because Intel's a little bit of an anomaly with their announcement today, and they're trading on the upside, one of the few semiconductors that are. So let's keep an eye on whether buybacks make any kind of comeback later in the year.